The inventory systems that can be used to track our products are something called perpetual system and a periodic system. So the perpetual system, you know, when you go to a store and you find those little QR bars or the bars that they scan, we've all seen those before, right? Or when you go to maybe a Trader Joe's or a grocery store, they scan, everything has a sticker on it. That's because they're using a perpetual system. So every time they scan an item, it's going to their accounting system saying, okay, we've sold this item now. So recognize cost of goods sold, recognize revenue for that item at that specific point. Some companies aren't that sophisticated or don't have those high volume of sales. And they use something called a periodic system, where at the end of every month, you have someone go and count all of the products on the floor and reconcile and say, how much did we start with? How much did we end with? The difference is what we sold. Even for perpetual systems, you still need someone to count monthly. You just don't need the same amount of effort. You might use those monthly counts. Might be a little easier to do because we know a perpetual system. We know what we've sold already, and we just need to double check the answer or spot check the system. So we use both of these systems, but even with a perpetual system, you still need someone doing the physical counts. Because products might be missold. Someone might scan the wrong product. People might steal product might go bad, right? And so we still need to assess that and consider it for our inventory costs. And so let's go through this problem together. So using the following information from a merchandising company, what are we trying to figure out? We're trying to compute goods available for sale, cost of goods sold, and gross profit. And we're going to compute the net income for each company. So let me show you how to do this in Google Sheets. And that way it's easier than just using your calculator. And you're allowed to use Google Sheets when you're taking your exams. I'm completely okay with that. And so put it over here. Can you still see my screen at this level? Can you put me in the, okay, awesome. And so we can go Save Co, Merchandiser, and we have the high-tech, probably service company. Let's see, high-tech services. I'll do that later. So we have supplies, beginning inventory, ending inventory, expenses, net purchases, and net sales. And so first, our good available for sale, our merchandise available for sale, we already have this calculation here. So we can just press Control-C, copy this, and then Control-V, and paste it, and then just plug in the answers. 100, and our net purchases, 80. We should have $180 of merchandise available for sale. Let's see here. Goods available for sale in the product, in the period. See how easy that is? And then we'll go compute the gross profit next. So the gross profit, we'll just have our net sales less our cost of goods sold will equal our gross profit, right? That's different than net income. So our net sales here were, it's too messy there. Our net sales were 190. Our cost of goods sold is they calculated it here, 130, which was our ending inventory. So our cost of goods sold here was our beginning inventory. So we'll just put in the math here. Beginning inventory plus our net purchases or our merchandise available for sale, less our ending inventory, which was, our ending inventory was 50. Minus, which is our cost of goods sold is 130. And I can put that separately too for you all to see. And then our gross profit would be our sales minus our cost of goods sold. Our net income for the company would then be less our other expenses. So our other expenses here were 20, right? You can see where we get this from, expenses of 20. And so our net income would be 60 minus 20. Maybe I can make this a little simpler for you so you can see how we can use Google Sheets to even streamline this further. So I could say save co-merchandiser information. And then I can put in all of the information we have here, right? Supplies, beginning inventory, ending inventory, expenses, net purchases, and net sales. We just copy over the information. 10, 100, 50, 20, 80, 190. Then we also need to know, then we can just make calculations based off of this information. And so if I want to know our goods available for sale, or good available for sale, gas, we know that's just our beginning inventory plus our net purchases, 180. This is another way to do it. If I want to know our gross profit, or maybe cost of goods sold would be easier because we know we need to figure out cost of goods sold. And this is our available for sale, goods available. Our cost of goods sold. Our cost of goods sold is our beginning inventory, or our gas. Our beginning inventory plus our net purchases minus our ending inventory is our cost of goods sold. And all the formulas are here, so you can see them. And then our net income is just going to be this minus our expenses. Or let's see, expenses of cost of goods sold. Oh, sorry, that's our gross profit. Gross profit is going to be the subtraction of these two. And our net income will be our gross profit. Let's see, where am I missing this? Goods available for sale. Oh. Let's see. I must have put something in wrong here. Available sale. Net sale. Oh, sorry, our net sales. Forgot that piece for the gross profit. Our net sales, which is up here. So 60, and then our net income is going to be our sales minus our cost of our expenses. And so to remember, our gross profits are sales minus our cost of goods sold. So we put that here, sales minus cost of goods sold. And then our net income is going to be our gross profit minus expenses. And so there's many ways we could use Google Sheets to calculate this, but now you can change these numbers and get the same answer. It'll just automatically calculate. If our beginning inventory is different, now it automatically calculates how it changes. If our expenses are different, 50, it should recalculate our, let's see, expenses here. Our expenses are different. If I change it to 60, it'll calculate the 0. That we just build a format and you can work with it. You're going to be using this kind of software in your jobs. That's why I'm trying to introduce it to you while we go through the problems. How is this different than our high-tech company? Supplies are a balance sheet account. And this is a great question because a lot of people confuse supplies with inventory. They sound similar. They aren't. Supplies aren't something we intend on selling. Supplies would be your toilet paper, your pens, your whatever you have for your office that people use and you don't intend on selling. It's still a balance sheet account. It's a short-term asset, right? Which means it has a debit normal balance, but we don't intend on selling it. Inventory, we sell for a profit. So the supplies here is on your balance sheet, but it's meant to throw you off.